Real estate offers income and stability, yet direct ownership is costly and complex. A real estate investment trust, REIT, gives an individual or small trust access to income-producing property through publicly traded shares, without buying or managing buildings. A REIT is a company that owns or finances income-producing real estate. Investors gain exposure to large properties, offices, malls, apartments, without taking on direct ownership burdens like maintenance or tenant management. Congress created REITs in 1960 to give ordinary investors access to commercial property portfolios once limited to institutions. This democratized real estate ownership for households seeking long-term income. REIT shares trade on major U.S. exchanges, providing liquidity similar to stocks. Investors can buy or sell easily, unlike private real estate holdings that require lengthy transactions and significant capital. A defining rule, REITs must distribute at least 90% of taxable income as dividends. This steady payout creates predictable income, valuable for individuals and trusts needing regular cash flow. REIT performance historically blends income and price appreciation. Long-term returns have been competitive with stocks and bonds, supporting diversified wealth-building strategies. Income originates from rent on owned properties or interest from financed real estate. Long lease terms and essential commercial usage produce consistent revenue streams uncommon in other sectors. REITs must disclose audited results and adhere to corporate governance standards. This accountability safeguards investors and ensures management practices remain visible and measurable. REIT leverage remains moderate, usually below 55%, lowering financial risk. Conservative borrowing protects capital and promotes long-term sustainability for small investors. FFO, funds from operations, is a key REIT metric. By excluding depreciation on real property, it reflects actual cash generation and helps investors gauge dividend reliability. Research shows REIT inclusion in portfolios can raise the efficient frontier, improving expected returns without increasing risk. This benefits smaller investors seeking balanced, disciplined growth. REITs span diverse sectors: apartments, malls, healthcare, resorts, storage, and industrial facilities. Sector variety helps cushion downturns and supports portfolio resilience. Mortgage REITs offer exposure to real estate lending rather than property ownership, earning income from interest. This provides another route for investors focused on yield rather than asset control. Valuation connects directly to rental growth, occupancy, and regional economic drivers. Rising property demand often supports rent increases and strengthens investor returns. Net asset value, or NAV, measures property value minus liabilities. When divided per share, NAV gives a reference point for assessing whether a REIT trades at a premium or discount. Capital expenditures preserve or enhance property portfolios, supporting NAV and long-term price appreciation. Well-managed improvements help maintain revenue potential and competitiveness. The REIT structure attracts both growth and income investors. These companies derive value from real assets and the expert management of those assets, traits appealing to disciplined stewards. For individuals and trusts, REITs provide scalable entry. With modest capital, investors access professionally managed real estate, reducing concentration risk and operational burden. Investors may select single REITs or diversified mutual funds and ETFs. Professionally managed funds provide instant sector diversification and reduce individual selection risk. Ongoing dividends can help trusts meet distribution mandates while preserving principal. REITs allow long-term strategies that harmonize income production with asset stewardship. REITs give small investors and trusts a structured, transparent path into commercial real estate. They offer liquidity, steady income, and exposure to tangible assets without the hurdles of direct ownership.